Hello, and thank you for joining us for the BlueStem Wealth Partners Financial Market Update. Today, we are joined by Scott Marquardt, Private Wealth Advisor and Managing Partner at BlueStem Wealth Partners, along with Chris Shuba, Chief Executive Officer of Helios Quantitative Research. Chris and his team are valued partners of BlueStem, and we are grateful to have both Scott and Chris here to share their insights and perspectives with us. As always, there's no shortage of topics to cover as they discuss current market trends, economic updates, and what investors should be paying attention to moving forward. Now, I'll turn it over to Scott and Chris.
Chris, good to see you again. Welcome to the next edition of the quarterly meeting, right?
The next one, man.
The next one.
I always laugh about how fast months go by, but now I'm starting to think how fast quarters go by. So,
oh man.
Yep.
We have I like the baseball thing, right? And I'm just like, man, when the weather starts getting nice, baseball's almost over, and we're moving into football and all the stuff. So it's just kind of crazy.
Well, so here in California, we don't have that problem.
True. Yes, we are in Minnesota. I am in Minnesota.
I'm like, what are you talking about? Oh, yeah, that's right. You have seasons. We don't have any seasons.
That's right. Yes, that's right. Very good. All right. Well, how about we? Unless you've got something kind of groundbreaking for us, we can just dive right in. We've got lots of things for you today.
Oh yeah, Jones, fire away. I've got lots of stuff as always, but I'll weave it in somehow, and take over the conversation or something.
Perfect. Yeah, that's fine by me. Very good. Okay, I think first place we're going to start. I think we've got some inflation, not super hot inflation, but definitely not very tame either.
Mm-hmm.
People are definitely noticing the prices, at the pump, at the grocery store, restaurants, all that kind of stuff, right? The things that people notice the most. And you've got interest rates that are, not super low. They're not really high. They're kind of also right in the middle there. So,
yep.
We're kind of wavering on this, this teeter-totter of our interest rates going lower or higher. They kind of staying the same. And how does this whole, cost of living continuing to go up affect economies and businesses and things like that? So just some comments on that if you've got any.
Yeah, as you were saying that, I was pulling something up because you reminded me of it. Because we do a lot of work on this, and so in terms of the inflation rate, right? We have two kind of important things that are still keeping it high. The first and the most obvious is the Strait of Hormuz closure, the war with Iran. And, as of this recording, that's still kind of hot and heavy, right? So there's really not an end in sight to that. And so obviously there's a lot of things that go through the strait. Oil's the famous one, but there's a lot of other things like fertilizers and all kinds of stuff that ultimately ripples through prices, right? And so we've seen inflation jump up from, in the mid twos to all the way into the mid fours. It's come back down. Now we're in the kind of the mid threes, but net on net, there's a lot of direct relationship between where inflation is right now and, of course, the strait. The other knock-on effects are still small hangover from even COVID era stimulus, but also a lot has to do with the tariffs, right? So the tariffs, as everyone knows, was shot down in their current form going back to a number of months ago, and then everyone knew that no matter what kind of side won in the Supreme Court, there was going to be a pivot. So the Trump administration pivoted and started using different sections. But the difference is those sections do expire. So there's been a substantially lower level of total customs revenue since that announcement. And then over the course of really the next month or so, we're going to start to see certain provisions, certain tariffs have to be moved to a new section, or they're just going to roll off entirely. So all of that will help with inflation to a certain extent. But we're not really going to get anywhere near where we want to be, or the Fed wants to be, which is at 2%, until certainly these two things are put to rest. And I don't have a timeline for either one of them, right? So we're just kind of living in that world at the moment. So that's the landscape on inflation, kind of where we are. So, core inflation, which is the measure that I think the Fed cares about the most, is actually doing okay. That had dropped down. It never really rose up a lot because energy, as an example, is not included in core. So it's more that headline number that's on its way back down. But overall, it's going to be higher for a while. And the big problem with it is actually not the inflation rate. The big problem is wage growth relative to inflation. And we've talked about that on this call before. But what we talked about previously was that it was okay, that we were seeing inflation, but yet wage growth was still outpacing it enough where people could afford it. But since it's jumped up to that 4-point number, and now even though it's dropped down to a 3-point number, that's now put the consumer underwater. So now on a real basis or an inflation adjusted basis, the consumers are actually, not just like emotionally being hurt by this, because I don't think anybody likes the prices, but consumers are actually now like physically not able to afford what they were before on an aggregate basis. And so we can last like that for a while, but if it isn't sorted out pretty quickly, we'll end up with some economic ramifications that will take a while to fix. So,
yeah, I was going to say, because that, while what you said is happening, we haven't necessarily seen that in economic activity quite yet, right? Because as you said, up to this point, prices were going up, but people were, even though they didn't like it, didn't have to adjust their lifestyle. And now, now that's happening. And I'm sure there's going to be a lag effect on that at some point here down the road if this continues. And so we'll have to keep our eye on that.
Yeah, I mean, we have seen an effect on consumers. We've seen the savings rate drop down consistently as inflation has remained high, right? So the 20-year average and kind of where we started, where we were like about, I don't know, a couple of years ago, we were right about that 20-year average of about a 6% savings rate. We were a little lower than that, 5.5. Now we're down to 3. So we've seen the savings rates just slowly fall. And that's because we haven't seen debt rates creep up on a normalized basis. We see debt levels overall increasing because of inflation, right? But in terms of the normalized dollar amount, we're not. So the consumer's been pretty good about just not getting into debt, living within their means, but not saving as much to get through this period of time. But like I said, now that we're underwater, at least for the moment, with the real impact on wage growth or in hourly earnings, you can use any of those calculations or anything that you see on the news. That kind of stuff is where we're sitting. So the consumer's in an okay place right now, and I think it's sustainable for 3 months, 6 months. But at some point in time, debt will come into play, and that's not what we want. So,
okay, so that would probably be, that would be considered a headwind, right? So at least a headwind for markets. So let's do a little pivot then and start talking about the markets a little bit. One of the biggest things that we work with you on is obviously, I'd almost classify it as ultra diversification, right? Where we're, in all markets, all bond types, basically, just about every asset class that you can think of somewhere in our model portfolios. And the big driver for doing that is the volatility management that we try to do in the models. So, a lot of people back, I'll call it even just 10 years ago, and even still today, we do some, the Dow is this, the Dow is that, and we always try to train, clients said that, the Dow is a very small piece of the overall economy, the overall market. And so if you're going to look at something like the U.S., we always, something more like the S&P, right? Well, even now the S&P 500, the big, the Meg 7 or whatever the biggest 7 companies make up such a big part of that index, and therefore some of the return, which a lot of that is AI, and everybody knows that there's been more, money pouring into AI. Are there things that we should be looking out, in those markets right now?
Yeah. Well, the concentration risk in any market cap derived product or index is prevalent across the board at this point. So when we talk about the market, a lot of people talk about the S&P 500, but the S&P 500 is not the market. It's a financial product, right? And so it's just the most famous one, maybe next to Dow or whatever it might be. But it's momentum weighted, right? So based upon the market cap, that's how much you own of that index. So, Apple and Nvidia are the 2 largest by market cap. So you own more Apple and Nvidia than you will own of other things, right? And so now the top 10 companies in the S&P represent about 38-ish% of the investment. So you're thinking about it kind of like a, getting towards a 50-50 portfolio, right? You have 50% of these 10 names, not quite 38's a far cry from 50, but you get the idea. And then you have the rest, right? So, so it's not the market by any stretch, right? Because the market is much broader than 38% in 10 companies. But we tend to look at what's on TV, and we see the S&P and so on and so forth. And so, but the reason that the S&P has been so successful is exactly this reason. It's market cap weighted. So the big just get bigger, right? And that's the reality of the product, right? So its success is also the detriment to it. And so now we sit back and we say, well, look at this concentration risk. It never used to be this way, et cetera, et cetera. And that's true because over time, growth type companies simply demand a higher price per unit of earnings than companies that don't have a lot of growth prospects. I mean, we used to draw the line between growth and value. It's kind of blurry now, but value used to almost always mean a dividend payer. Well, the reason that you have dividends is because you don't have something to invest in. You just have extra cash. So you're paying it out to your shareholders, right? Whereas growth companies usually don't pay a dividend because they have so many new things they want to build, right? But if I make toilet paper, there's not a whole heck of a lot of like new technology going into advanced versions of toilet paper or toothpaste, right? I mean, there is some R&D, but it's very small. So, but all those lines have been blurred now, and there's nothing that's going to change this. I mean, the methodology of the S&P is exactly what we're getting. And so the question is that are we going to get more volatility out of the S&P because of the concentration risk? And the answer is that we can. It won't always be more volatile, but we certainly can if the volatility happens to hit a certain type of product, right? And so, obviously NVIDIA, Apple, Microsoft, to a certain extent, Amazon, Google, Facebook, Micron, those are in the top 10, and they're all in part of a similar trade right now. So as those guys get hit, yes, we're gonna feel that, right? But we've been pleasantly surprised from time to time where the other, 490 in there might be doing all right, and we've seen that support the S&P. So strategies that are deployed against this either kind of mirror this type of overweighting, but then kind of pick and choose some variance to it to try to outpace the S&P or be a little smarter than the S&P over time. And there are strategies that are effective at doing that. We run some of them. And then you have the ones that are high variance strategies where you're really digging into a sector and almost ignoring this top end when it's not attractive. And those strategies can be really attractive as well, but at the same point in time, you get a lot of variance with them. So, and most investors don't like variance unless it works out in their favor, right? But when it doesn't, it's you look at your statement a little bit weird. So, I think the question you asked is, should we be concerned about the concentration? And the answer is, I don't think you should be concerned about it as long as you're aware of what it is. And if you don't like that concentration, there's different ways to have exposures to these this same group of large cap stocks, but by doing something different, creating that variance that's more comfortable for you, but of course will give you different results, right? And that's the drawback. So
well, and that's part of why we build the portfolios the way we do is, we won't just use an S&P 500 fund, for example, as our large cap investment, right? We'll go into the growth, the value, or even potentially into some sector or something like that, if in fact we feel that there's too much risk in one spot too. So, okay, so on those same lines around these 7 or 10 companies, in the S&P, for example, kind of getting to those huge valuations. And to some degree, in some cases, earnings are kind of supporting that, but in some cases they're not, right? I mean, some of it may be a little speculative, especially around the artificial intelligence and things like that. But, one of the things that most clients probably don't follow, but it's a number that's out there, is the Shiller PE, right? Which is, historically looked at as, an inflationary adjusted price to earnings number over a 10-year period of time. And, and that's That is really quite high right now, right? I mean, historically, over 30 has been pretty expensive, and it's
Mhm.
hovering in the 44 range-ish, something like that.
Mhm.
So there again, just some thoughts on how to, how to look at that, what that means historically, and then also what are we doing to, position ourselves to, not get killed by something that's way overvalued and, just protecting some of that principal and managing that volatility.
Yeah, I mean, the Schiller ratio, or a lot of people call it CAPE, has been around
Yep.
forever. We do track it. I just pulled it up while we were talking, and we actually have analysis on it that goes back quite a while. In terms of what I like about it is that it's something that's been around a while. Some people have familiarity with it. It does attempt to um, kind of get its head around inflation adjusted earnings, which is topical at the moment. Its purpose is about kind of a long run viewpoint on valuations. It has never been a good trading tool. It's
Right.
almost like has absolutely zero predictive power in the near term. So it's more about kind of where do we sit. The problem with CAPE is that it really started to be phased out of any sort of meaningful kind of professional analysis because the tax laws changed a number of years ago that really kind of hit the way that it works, at least, as it was originally designed, right? So if you keep that calculation constant, there's just, it just is, it's never been upgraded for modern accounting principles, right? Number one. And I could go into that, but just kind of take it from there. Second
Yep.
thing is that it doesn't have a way to kind of handle what we've talked about already, which is that index kind of top heaviness, um, because it's not really parsing it out by company all the time. And secondarily, it doesn't have a way to understand how buybacks affect PE ratios. So that makes everything look higher than it really is because of the buyback effect that happens way more frequent than it did 50 years ago, right?
Right. Yep.
So there's a whole lot of problems with CAPE, which is why I like it as an interesting conversational point. And I like that it's old and people know about it. But in terms of its value, in terms of us saying, well, something's overvalued or not, it really isn't in that mix anymore. Realistically, go ahead, question.
Well, was just going to say, yeah, so I think, there's really nothing that and I won't say nothing, but very, very little of what we do
Mhm.
is trying to, predict what's going to happen over the next 3 months, 6 months, right? I would almost say that we just don't, we don't do that at all.
Mhm.
It's just more of from a
Perspective.
an advice perspective, right? That
Mhm.
how do we position that for clients? Is it smart to potentially assume lower, investment returns out of the stock market over the next, 8 to 10 years because of that long-term nature of that indicator, or is that just not something that's necessarily true, and that's not a good thing to think about.
Yeah, I mean, there's I we track every economist that publishes everything, right? And it's kind of a joke because these are brilliant people, like really, really, really smart people. But they publish things like this is what you can expect in return for the next 5 years or 10 years. And they have been so shockingly wrong every time because you can't account for innovation,
Yeah.
right? You can't account for what shifts the productivity curve, which is always something in technology or
Hmm.
something in raw capability or massive legal changes or you name it, wars, all
Hmm.
kind. I mean, the world gets shaped in dramatic ways over and over and over again. So anytime anybody tries to take a 5-year view or a 10-year view, if there had ever been one that was like a systematic way of being right about this, um, I would know, right? We track everything, but there just
Right.
isn't. There's no possible way to do it. The only thing that is true is that there is an innate upward pressure on the market, um, and everybody wants it to keep going up.
Hmm.
So there's the one thing that's always been true over and over and over again is that, we want to mitigate the opportunity for sustained and deep volatility patterns like an '08 or a 2000 or whatever. But other than that, you know, you got to go with the optimism, right? You got to go with the fact that 5 years ago, you can research people that said, we won't get more than an 8% rate of return over the next 5 years. And it was 30%, 25%, 15%, and it was 60%. It's not just wrong. It's like ridiculously wrong. So CAPE ratios are in that grouping of where if nothing ever changed, it could be pretty accurate. But the fact is something's going to change. And so because of that, it just makes it so that you almost have to live by shorter term indicators and make your way, quarter by quarter, 6 month by 6 month, year by year, where the horizon for productivity enhancement like technology is much more known. Right.
Yeah.
And so I don't know, that's my soapbox.
Yeah, no, and I think that's good. I still think that goes back to, not getting too excited about what's going on in the news, what's going on in the media, because things do change. And, I just made an example yesterday with a client. I said, go back to, in the 1960s and, in the Vietnam War, and, everybody's wondering why the heck we were there. Nobody knew, nobody liked it. Casualties were mounting, all the bad stuff. Consumer sentiment was like at an all-time low. And yet you look back 50 years ago, 60 years ago, and that was a great time to be an investor if you were 30 or 40 years old, right? Or even 50 for that matter, right? So, the markets don't always do what we think they're going to do. And of course, the longer we try to predict that out, the worse it gets, right? As far as being accurate. So, well, good. Well, we are running short of time. I'm sure we could sit on here for another 45 minutes. I know it flies by. We're already past 20 minutes. So, Chris, as always, thank you for giving us your time. We've gotten some positive feedback from this, really positive feedback from some clients. So they really appreciate what you bring to the table. So if you watch this webcast, you have questions for us, obviously give us a call, 612-464-0372. That'll get you to our through our main line at the office, and they will direct the call to the advisor that needs to be contacted. And we appreciate everybody attending the call, and any feedback is welcome. So we will use it to try to be better every time, right, Chris?
We'll try. I just got to get me to shut up.
in the next quarter, that will be here like that.
Just like that.
All right. Thank you, buddy. Appreciate it.
Bye, folks.